Before we started the show, you mentioned a blueprint of like, hey, someone that's starting in multifamily investing, what's the blueprint for getting the loan you need for your first project?
Everybody wants to jump in and we want to start underwriting, and it's exciting. Before you jump in, what is the roadmap? You have to kind of figure out what you qualify. Do you qualify from net worth position, from liquidity position, and from experience? If there's an operator that's been doing this for a very long time and is struggling in this cycle, does not mean that they are a bad operator.
Say I'm someone new, listening to this podcast. I'm doing my first multifamily deal. Who am I looking for on my team to help me, and where can I find that person or persons?
Yeah, so that's always the question.
Hey everyone, and welcome back to the Apogee Wealth Podcast. I am very excited for our guest that we have today. She is a legend, if you will, in the world of multifamily investing, a great friend, partner, and I'm just glad to have a conversation with her today. So when you go into multifamily investing, and we'll talk a lot about this over the next few minutes, your biggest partner on the deal is actually your lender, as Julie will mention. And so Julie Anne Peterson is a mortgage broker with Old Capital, one of the largest, probably the largest mortgage broker in Texas, if I would have to guess. And she's here to tell us all things today about multifamily loans. Julie, welcome to the show.
Oh, well, thank you so much. I'm excited to be here, and such a pleasure to be on your podcast here. I would tell you that Old Capital, we started in Dallas. We do 1 in every 3 loans in Dallas. So we are the place to be getting your debt from. So I'm excited to chat about what we've got going, what we're seeing in the market, and how we can help your investors.
Yeah, I appreciate you taking the time to chat. And, one of the things I enjoy about talking to you is you're great at breaking down things that could be rather complex for newer investors that might be difficult to understand. You're great at breaking them down in a way that's very digestible. And so looking forward to kind of walking through that. And so along those lines, before we started the show, you mentioned a blueprint of like, hey, someone that's starting in multifamily investing, what's the blueprint for getting the loan you need for your first project? And so I'll let you just kind of start with it from there and give us some things that we should think about if we're going to get a loan on a multifamily investment.
Yeah, absolutely. So, listen, everybody wants to jump in and we want to start underwriting, and it's exciting. Every time you sit down at your desk, you're thinking, hey, is this one going to work? And what we want to make sure is that before you jump in, what is the roadmap? What do we have to do? What do we have to know about our team and about ourselves, quite frankly, about how we're going to put our team together? Again, we are your biggest partner and we will help you get the loan. But before that, we have to kind of figure out what you qualify. Do you qualify from net worth position, from liquidity position, and from experience? So I kind of back it up and I say, hey, have you looked at your personal financial statement? Have you even filled one out? Because when we look at the very best lending solution, which in my mind is, and a lot of lenders will think, if we can get into agency lending, which is your Fannie and Freddie, non-recourse lending, you have to have these 3 things: the net worth equal to or greater than the loan amount. You have to have liquidity, which means cash in the bank that's going to sit there until you close. And you have to have experience. So the personal financial statement is a great resource to kind of figure out, okay, what's my house worth? What are my credit cards? How are they hurting me? What are my 401ks, IRAs? All of that in one spot where you can kind of figure out, okay, this is really for me where I can play. All right. And then from there, we can try and figure out, okay, if you're looking at $10 million deals, and if I'm the lender and I'm bringing 70% of a loan, that's $7 million. You have to have $7 million in net worth. So if you do your personal financial statement and you're only worth a million, you have to find one or two partners. Ideally would be one. You can check that box. Who has 6 million with your one? That's 7 million. Now you've got your net worth. Liquidity is going to be 10% of the loan amount. So in this case, 7 million, 10% is 700. Now, when you look at your personal financial statement, if you only have 50,000, that's going to be more challenging to find the right partner. And liquidity, as I mentioned, it's cash in the bank, and a lot of investors like to deploy their capital. So finding somebody who has net worth, liquidity, and then experience, we're looking for somebody who has 2 years of experience with 3 to 5 transactions. If
Mm,
you're new, which everybody has to start someplace, what I love about this business is there are people that are here to help you, that will help sign on the loan. They're called a guarantor. And so what we're looking to find out is how much experience do they have in multifamily or in single family. Now, here's the great thing. In 2023, well, previous to coming to Old Capital, I myself I was in single family, and I had many doors, but I could not use those in multifamily. So in
mm,
2023, we opened the door to single family people, and the guideline there is 10 single family doors that you've owned for 2 years. Now that person will help you, or maybe you have it, you would qualify for agency a 5 to 50 unit building. I mean, it is truly
mm.
amazing now. Now, these Fannie and Freddie, they start at $1 million. And in today's environment, $1 million loan amount, it is tough to get done. It
Mm.
used to be not as much of a challenge, but new things have popped up when it comes to agency. They're really digging in. So, want to make sure that we're talking about how agency has changed over the years. Especially in our new environment here.
Yeah, not to go on a tangent there, Julie, but just a question that I have as a frequent agency borrower. For years the Freddie SBL program was like
Yeah.
a great product for new investors, like you mentioned, coming into multifamily. And so for someone that maybe they have a dozen units of single family, they're wanting to go into small multifamily, and they're looking to do let's just say a $2-3 million loan. What does agency have to offer with kind of the at least as I understand it, the end of the Freddie SBL program?
Yes. So we still have Fannie, and that starts at 1 million.
Hmm.
Okay. And these are non-recourse loans. Now it will depend on where the deal is. And if it is a small tertiary market, you're going to probably be at 65% loan to value. And you're probably looking at a debt service of 1.35, maybe 1.3. But if you are in a Fannie loan and you're in a top or standard market, we can get 75 to 80% leverage, which is fantastic on a 1.25 cover. And if you're like in Dallas, let's say in the city of Dallas, we can get to 80 on a 120 debt service. So there's amazing stuff that gets done on the smaller transactions on Fannie. If we go to Freddie, those are now starting at 2 million. Now,
Hmm.
Freddie used to be awesome, and it still is fairly awesome, but at 2 million or before the product before, you could lock the loan the day you sign.
Hmm.
Unfortunately, that's not happening today. It is just the same basic premises where you lock the loan about 3 to 5 days before close on Fannie and Freddie. But these loans are 5 year, 7 year, 10 year, and on Fannie you go to 12. On Freddie, you can go a 20-year loan with an amortization of 30 years. So there's lots and lots of options in this area of agency financing. What I love about it is you're looking at the non-recourse piece where you're not guaranteeing personally. Now, there are carve-outs, we call them. So if you were to sign on the loan and you were having bad behavior, let's call it, we call it bad boy carve-outs, it would switch to recourse. But we're hoping that you're going to stay on target and you're going to do what it takes to manage this property and do a good job so it stays in non-recourse. Um, but it's a 30-year amortization. Whereas if you go to a bank, you're talking about 20 to 25-year am. So the way that gets interpreted is your monthly payment on a agency loan is less than what we would be seeing on a bank loan. The other things to be thinking about on those smaller loans is a lot of times it's small numbers and you have to have 90% occupied for 90 days. And that's real
Mm,
important because when you're looking at the leases, if you get in today, let's say we're in July and we are going to close in September. So you have 60 days. You want to make sure you're looking at the leases to see over that 60-day period, are we going to lose some people? Are they going to be moving out? Or have they re-signed? Because what you don't want to have happen, especially on a Fannie loan, is for one or two people to move out. And what happens is then you drop out of your 90% occupied and the deal blows up. On
mm,
Fannie, you have to walk away, unfortunately. On Freddie, it will be more of an average of 90%. So you get into it, it's 92. Somebody moves out on a small deal, it becomes 87. And then we go to 92, back up to 92, let's say, when we close. That's okay on the Freddie, on the Fannie, not so much. So again, some of the challenges when we're looking at small deals. Uh,
yeah,
yeah,
that's all really great info. And I like that you mentioned the 30-year am. I think some newer investors really consider the bank loans, and I know y'all help with those as well if that were to be a better
yes,
product for someone.
sure.
But you lose the 30-year am, and your higher interest rate combined with the higher amortization oftentimes hurts your proceeds. It makes your payment higher, and of
Yeah,
course, sometimes you're looking at recourse debt in that case, which people may or may not feel comfortable with. So that's great. You mentioned all these different options for agency, and I think a lot of newer investors they only ask two questions, right? Like, what's my interest rate, and what are the proceeds that I'm going to get? How much is my loan
yeah,
balance, so they know how much they need to raise. I think another important question that they often don't think about that maybe you could speak to a little bit is the term, right? Like, how long do I want this loan for? How do you work with investors on matching the term that they're asking for to the business plan that they're working with? And
yeah.
why is that important?
Yeah. Before 8 years ago, 5 years ago, we put everything on 10-year debt for the most part because it gave you a good runway so that, and the 10-year treasury was the cheapest debt.
Hmm.
We were at 3%. You add 1.5, we were at 4.5, and even below that. The 10-year treasury now is up. It's considerably more expensive. So, kind of the 10-year treasury is not out. So, what we are looking at is a 5-year and a 7-year treasury and the 5-year is the cheapest of the two. And it's because there's such uncertainty. The treasuries are based on public sentiment. So, when we got into the war recently, it shot up.
Hmm.
So, some of the things that we want to be looking at is how long do you plan on this business taking to get new people in? If you've got a renovation budget, it's going to take, if you're organically raising the rents, you're doing the turnovers when someone moves out, it may take you a good 3 years to get through all of those renovations. So, we really want to marry the right debt to the business plan. And I would tell you that on a 5-year, these things are taking longer. So it is risky right now to get into a 5-year loan. We we do more 5-year loans, but as an owner operator myself, I know that things are taking longer. And we're in a cycle right now where occupancy is just starting to come up in a lot of markets. And if we come in and we're thinking, hey, we're going to raise rents, we're going to, renovate all these units, we have to be cognizant of what's happening in the market. Because with occupancy, it being very challenging, you might go with your business plan thinking, hey, I'm going to turn all of these units in a year, but then you're waiting for people to show up.
Hmm.
So I've seen more organic renovation plans coming, and with that, it's taking a little bit longer to hold on to these assets. And a lot of times when we're looking at a 5-year loan, the business plan is I'm getting in, I'm renovating, I'm leasing up, moving really the rental rate, and then I'm going to sell. The idea of 7 years is more just a runway of, hey, I'm going to evaluate. If the rates go down, then I can go and run and refinance it. But if they don't, at least I know it works today and it should work tomorrow based on the stress tests that I've run.
Yeah, I really like that perspective. For a long time, I liked the 5-year products better. And I would say within the last year, I really like the 7-year loan
Yeah.
product. And obviously, it depends on your business plan, as you mentioned. But it gives you 2 extra years in case you're wrong. Like it just takes longer to do things. Oftentimes, is you can ask for more IO on 7-year, which is sometimes helpful. The only negative is, of course, your prepayment penalty. If you really did want to exit at like the 4-year mark, you could be a little prohibitive on that. But overall,
Well,
I
let's
agree with you. I like the
let's
seven
talk
year
about
product.
that. Let's
Yeah,
talk
tell
about
us.
because
Yeah.
every deal in multifamily, in commercial real estate, has a prepayment penalty. So
Hmm.
you have to be thinking again, what's your business plan? Am I thinking about, oh, in 4 years, if the interest rates drop, what is my prepayment penalty? So the cheapest debt used to be 10-year yield maintenance. Now it's 5-year yield maintenance. And by that, yield maintenance is, well, I have to make, I'm telling the lender that I'm going to hold this asset for 5 years. And so they know that over the next 5 years, they're going to go out and open up their mailbox and they're going to get their check and they know how much so they can deploy their other capital at higher interest rates. But let's say in a 5-year loan, you say, hey, I'm done with my business plan. It's 3 years. Well, you don't know how much it's going to cost to exit that loan. And you may have told your investors, well, we think it's going to be this amount. We think we just don't know. So yield maintenance can be a little bit stressful because if the interest rates go up from today's rate of, let's say, 6.15, and they go up to 8.15, hey, those investors that gave you the loan, they're chomping at the bit to get out of your loan early. They're okay with it because they're going to deploy their capital at the 8.15. But it's not the same if it goes down. So you are in your 8.15, or sorry, 6.15, and it drops to 3.15 rate, 3.15 rate. Then now they're going to say, hey, for 5 years, I was told I was going to get paid a lot of money. And so now to get out of that loan, it may cost you $500 to $1 million. And it has happened to me where it was going to cost us $2 million because we didn't realize that it was a significant impact on the rate. Okay, so yield maintenance, if you like to sleep at night over the period that you're holding, you got to understand where the forward curve is and where you are in the cycle. And it's a practice, that's not certain. So there is risk on the yield maintenance, but it is the cheapest. Now, step down is another thing. It's an offering that says, hey, on a 5-year loan, this is 1, 2, 3, 4, 5. On the first year, your step down would be 5%, and then 4%, 3 and 2 and 1% to get out of it. So knowing if you held on to it, it would still cost you 1% to get out. But at 3 years, 5.43%, you now can underwrite at 3% in your business plan. This is super important. Now, to have that yield maintenance and step down, this step down is going to cost you a little bit in rate. It'll cost you anywhere from 20 to 50 basis points, and that fluctuates depending on where we are in the cycle. Again, the yield maintenance is the cheapest, no extra costs for that. And by the way, the 54321, we could also structure it as 310 or
Hmm.
33221. So each of those, just like when you go to In-N-Out Burger or Whataburger, you can get your onions, whether they're grilled onions or they're chopped raw onions. There's all different ideas. And so we can kind of structure it to marry. Again, the debt has to marry the business plan. And that's a great example of the conversations we're going to have. There's a decision tree that a lot of operators don't think about. You had mentioned it, Jonathan. What are the proceeds and what is the rate? Well, some people are only, especially in this cycle, are only concerned about the proceeds. And why is that? Because it's hard to find capital right now.
Hmm.
So proceeds overshadow and have for many months and quite a few years. Proceeds are the most important. We can buy down the rate. Let's say we quote you 6.5, but if you pay a little bit more money, 1 to 2%, you can bring that 6.5 or 5.5 down, right? So that'll give you a little bit more proceeds, but it's going to cost you a little bit. So there's a lot of variables when it comes to lending that you need to understand. And knowing, do I want proceeds, or man, I cannot get away from this rate. It cannot go higher. And with the influx in the treasuries, and as we talk about SOFR, everything is so volatile right now. If the rate cannot change, then it might make sense to buy a rate cap, or you can buy down the rate so that again, on these agency loans, that rate, we call it ride the rate, because it's going to go up and down on both Fannie and Freddie for the period of 60 days, and then we lock it in. So have some flexibility there. Really, really important.
I hope you're enjoying the content of this episode. I want to take a quick 15-second break to thank our sponsor for this episode, which is Apogee Capital. Now, Apogee Capital is our private equity firm that we allow investors to participate in large-scale multifamily investment opportunities through. If you're interested in being a passive investor and would like to learn more, you can find information on our website, www.apogee.com. Link is in the show notes. Now, thanks and enjoy the rest of the episode. Yeah, that's all very useful information. And, another reason why you need someone, a lender on your team from the beginning of the inception of, when you're looking at deals, underwriting your
Yeah.
business plan to help you, because it makes such a big difference on your returns, on the risk of your business plan, based on the debt that you get, right? How much proceeds? What's my rate? Do I need to do a buy down? What does the buy down cost, etc.? What do I need to underwrite for prepayment penalty? All that stuff goes into the underwriting and can have pretty consequential differences on what you have as a result from it. Not to backtrack, but I don't want to miss something that could be useful to people. At the very beginning, you talked about thinking through your personal financial statement and assembling your team ahead of time. So, say I'm someone new, listening to this podcast, I'm doing my first multifamily deal, whether it's, $5 million, let's just say $5 million loan as an example, right? And, I've got my $1 million net worth, my 50K in the bank, and I'm like, man, I've got some work to do before I'm ready to go find a loan. Who
Yeah.
am I looking for on my team to help me, and where can I find that person or persons to get my first loan?
Yeah. So that's always the question. We in commercial real estate, we're always finding ways to meet people, right? Going to your RIA meetings, going in your masterminds, going to your local meetups, right? I do a Zoom at 8. You guys are all welcome to come to Zoom at 8. These are places where you're going to meet partners, partners like lenders, like um, investors, because you're going to need money to help you on this. You're going to look for general partners in that. You're going to find plumbers, contractors. So all of your team has to kind of be cohesive. And it's important that you set those up early. Property managers, you have to make sure you know, like, and trust them. Now, your lender's your biggest partner, but I'm a little different because I know a lot of folks that are looking to sponsor, that are looking to help people. Most lenders or brokers, they're coin operator. They want you to just bring them the loan, and it's a one and done. But Old Capital, we've been doing this for 38 years, marrying sponsors and lenders and marrying investors. So we kind of help that ecosystem for you to get to your first, second, and third deal, because it can be very challenging to find these people. you know, Not only that, but you also want to be, yesterday, we want to be having the conversations about, hey, I'm in multifamily. I am looking for investors. Have you ever thought about investing in multifamily? And these are the reasons why I'm doing it, and would love to, sit down and chat. Those conversations are super important early in this transaction, because those are the people that you're going to call when you do end up getting a deal. So it's priming the pump for these relationships.
Yeah, I agree. And it's always been important, but I would say in this economy more so than ever, right? Investors as a whole are a little more cautious, I would say, than what they were 3, 4 years ago. And so you need a strong relationship with that person, whether you're talking about an investor or a sponsor on your loan. You need a good relationship before they're probably going to agree to partner with you. And so getting
You
that
know,
started early is to your benefit.
yeah, absolutely. And I always think about, okay, I am a nurse. I'm not a nurse, but if you're a nurse, you it's the people that you're dealing with on a daily basis. You've got doctors. Go and talk to the doctors. You're an
Mm.
attorney. You have other attorneys. Start talking to them. You're a pilot. Go talk to your pilots. So I kind of think it's like a fraternity. Police
Mm.
officers, military people. That's your fraternity of people that are looking for opportunities. So kind of start to think, maybe you're involved in a church. Those are your people. Start to think about where you'll go to start networking and bringing in capital.
Yeah, I like that a lot. Want to go on a little bit of a tangent just for a second here. So we're kind of speaking, or we have been speaking to, people interested in being a general partner on a deal, which is, of course, the person doing the sweat equity, right? Finding the deal, running the deal, assembling the team for the deal. I want to talk just for a minute to limited partners or investors on deals, because we have a lot of people in our audience that they're interested in real estate, but they don't want to go do all this work that we're
Yeah,
talking about, and they just want to invest. And there's been a lot of limited partners who have been disappointed the last few years at performance of multifamily investments. And I would say in not all, but many cases, that rides on the debt product that they chose or some component to the debt that's on their
sure.
investment. Is there a few red flags that you could help limited partners understand that when they're reviewing a pitch deck for an investment that they should be looking for? What are some of the key questions they should be asking about the debt on a project they're interested in investing in?
Yeah, I mean, that could take a whole hour, because there's so much important information to be thinking about, to be considering, right? At the end of the day, there's a trust here that you really need to feel with this person. And I will tell you, it's been rough. if you've been an investor over the last 5 years, we were saying survived at 25. Well, we're in 26 now. We're still trying to survive based on what happened with the interest rates. And by the way, that might not be in a lot of these situations that you may have invested in or other people that you're in contact with. They invested in an operator that wasn't able to provide
Mm,
distributions. They lost the deal. That is not in a lot of cases because they were bad operators. I want to caution you that about that. If there's an operator that's been doing this for a very long time, 40 years in property management, and is struggling in this cycle, does not mean that they are a bad operator. Keep that in mind. It is simply a function of what happened. It was a perfect storm, if you will. Interest rates started going up. We had all of these deliveries. I'm sure you've heard of this. And occupancy went down, expenses went up. So all of that caused a huge problem in the market. And many of us have lost. So thinking about, okay, I'm wanting to get back in. But what we really need to be considering is who is this person that I'm going to be investing in? How many assets have they gone full cycle on? How much did they return? And how many was that before 21, 22? Because there
mm,
is a success story from before 22. Now, if they got into it in 17, 18, things were great. Things were awesome. So dig into what's the previous operator. How did those deals go? So thinking about that, also thinking about, okay, what markets are they committed to? Because if you've got an operator that's in a whole bunch of different markets, they're not necessarily the professional in that particular market because we want to have them go deep because then now you're worth more to the operations in that marketplace. You're setting the tone, you're setting the pricing. If you only have one deal and they're all different areas, you're just playing the game. So see how deep they are into that market. And then I would say, I mean, there's a whole bunch of different other things I would say, but I would, when you're looking at their underwriting, I would get a sense of where they are in the rent growth and the expense growth. Okay.
mm,
If you're seeing somebody in a Dallas market and they're buying right now and they're expecting a 5 to 10% rent increase, I think that you should challenge that.
mm,
Okay. It is that's a significant increase, and I don't think we're seeing that right now. Do I think we're going to see that, let's say, in 2 to 5 years? Absolutely. We're starting to gobble up all of those new deliveries, but to be honest, the first year, I think we should be looking at flat and maybe negative. So no returns the first year. Second year is flat. Again, I wouldn't expect any distributions. Third year, I think you're starting to see it. I think you would model 1 or 2%. Okay. So really start to think about, okay, where are we at in this cycle? Is this reasonable? How much, again, depending on where you're looking, Columbus, the Midwest, by the way, is amazing. We didn't deliver as many deals there. So to get rent growth in the Midwest is very reasonable. Okay? Very reasonable. And a lot of people are running there. If you're looking at Dallas or Austin or Phoenix, really be careful when you're looking at those rent increases and expenses. We saw a huge increase on insurance and taxes. Those are starting to come down in many markets, which is super helpful, but they still exist. And a lot of these operators, another question you could ask is, what have you implemented over the last 3 years to improve your NOI?
mm,
Because you cannot do the same thing we were doing 10 years ago. We need to be looking for solutions of reducing the expenses. Maybe you're doing having a program where you get your insurance policies. You get a rev share on your insurance policies. Maybe you're not doing as much apartment.com and you're doing more Facebook Marketplace. Have those questions. What has changed over the last 5 years? That is super important. Yeah.
Yeah, I agree with that completely. I think
Hmm.
prior to 22, if you bought a good deal in a good location, you could run it, let's say average, maybe even poorly, and still come out okay. And now you have to run well. And so a lot of the
Yeah.
questions I ask on track record is more asset management, right? Yes, you want to know full cycles, and like you said, there's a differentiator between those that were full cycle before 22 versus after. But what about improving NOI? Like, how have they pushed NOI? Because that's the thing that will carry you through, hopefully, any market cycle. If you're prepared to operate the deal to the best that it can be operated. Um, Really appreciate all the insight today, Julie. This is obviously, I know we could talk for hours
Yeah.
for people. They may not want to listen quite that long, but this has been
Yeah.
super useful. I think for both someone jumping in as a general partner as well as our limited partner tidbits here in the end. I know you yourself, Old Capital, have a ton of resources, a ton of ways that people can get involved. Do you want to list just a few of those for listeners where, things they
Yeah.
may want to join in on or opportunities here this year?
Sure, absolutely. So we really are committed to education. We want everybody to, our mission is nobody loses money. We do our
Mm,
best to save you from getting or losing money. So Old Capital Conference, we do it on a yearly basis. This is our 10th anniversary of doing it, and it's usually very creative. We've been to a lot of different sites. We're at the Harvest place in Dallas coming up September 23rd and 24th. It's 449. It's well worth a day and a half of being with other investors, sponsors, lenders, property managers, all of the people that you need for your team are there in one spot. It is really rich in information as well. So, Old Capital Conference. We also do the Old Capital podcast, which is amazing. We've been doing that for, I think, 12 years. And we do not tell lies. We really kind of bring up and make you aware of what is happening. We don't sugarcoat it, is what I should say. So, Old Capital podcast, take a look at that. We also are doing an accelerator program. We are helping bring in limited partners to help our clients to get into the deals. And then Zoom at 8 is another resource
mm,
to help educate. We bring in the best of the best of networking folks that have been doing this for a long time or are brand new, and industry experts to talk about their product, their service. So you get a sense of, okay, I'm going down this road with this company, but I haven't looked at other resources. So it's an hour and a half every Tuesday night. If you're in Dallas, it's called Zoom at 7, but it's Zoom at 8. And that's East Coast time. You're welcome to join us. Just you can sign up at zoomat8.com. So would enjoy spending time with your folks here.
Yeah, all great events. I was at Old Capital event last year, conference,
Yeah.
just fantastic event. And like Julie said, if you're a new investor, there's no reason not to go. Like everyone that you need for your team is there. So it's like one stop shop and meeting people in person. And then Zoom at 8 actually started during COVID, right? Am I
No,
wrong, or was
seven
it
years
before?
ago, 7.5 years ago.
Okay, so before
Yeah.
COVID, I got
Hmm.
involved during COVID
Yeah.
because I was at home and had nothing to do except learn about multifamily.
Yeah.
So been familiar with it for a long time, and it's
Hmm.
really a value event. Julie doesn't charge for Zoom at 8. You just
No.
show up and participate, and so there's really no reason not to take advantage of that. So, Julie, thank you so much for your time today. I think this has been
Yes.
beneficial for all the listeners. I'm always interested to hear what you have to say, and hopefully we have some brighter days ahead in multifamily investing and a lot of wins in our future.
I look forward to it. It'll be good things are ahead. Good time to buy
That's
now.
right. Couldn't agree more. Thanks all the listeners for joining in, and hope to catch you with us on next week's podcast. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.